Welcome to Talk Tickers. Today, we are stripping the varnish off a phrase that usually signals the end of the line for a company, but weirdly, often marks the beginning of a very dangerous game for retail investors. Chapter 11, Bankruptcy.
It is the ultimate financial paradox, isn't it?
Yeah.
You see the headlines scream collapse or bankrupt.
Yeah.
Yet you walk past the store and the lights are on, you book a flight and the plane takes off, and most confusingly, the ticker symbol just keeps ticking.
Right, and that creates this massive optical illusion. People think, hey, the business is physically there, the logo's still on the building, so my stock must still be worth something.
And that's the trap.
That is the trap. So our mission today is to really unpack why that is almost never the case. We're going to go deep into the mechanics of the filing, the legal tightrope the board of directors has to walk, and this brutal, non-negotiable thing called the absolute priority rule.
Which is essentially the law of gravity in the bankruptcy world. It dictates who eats and who starves. And spoiler alert, shareholders are usually the ones starving, even if they think they're buying a bargain.
We've got a stack of case law, accounting standards, and, market psychology to get through. We'll wrap up by looking at why, despite all the math saying stay away, retail investors still pile into these stocks like they're buying lottery tickets.
It's a fascinating question.
But let's start at the very beginning. Chapter 11 versus Chapter 7. I think for the average person, the word bankruptcy just implies, a padlock on the door.
That is the most common misconception. The padlock scenario. That's Chapter 7. That is the nuclear option.
The end of the line.
Total end of the line. In a Chapter 7 filing, a court-appointed trustee takes the keys, they fire the staff, they sell the office furniture, they liquidate everything. The business, legally and physically, ceases to exist. It's a funeral.
Okay, so Chapter 7 is the burial, but Chapter 11 is different.
Chapter 11 is the emergency room. The goal here isn't to kill the company, it's to save the patient. The company goes to federal court and asks for a timeout from its debts so it can restructure and try to become profitable again. And a key term you need to know here is debtor-in-possession, or DIP.
Debtor-in-possession. It sounds a little bit like a supernatural horror movie title.
It does have a spooky ring to it. But in legal terms, it's actually good news for the company. It means the existing management team, the CEO, the CFO, they stay in charge.
Wait, really? The CEO who arguably flew the plane into the mountain gets to stay in the cockpit?
In most cases, yes. The logic is that they know the business better than some random court-appointed lawyer would. If you want to save the airline, you need the airline guy flying it.
Okay, but with some supervision.
A lot of supervision. They aren't flying freely anymore. They're now debtors in possession, meaning they're doing it under the strict watch of the bankruptcy court.
So they have a federal judge effectively looking over their shoulder at the flight plan.
Constantly. For any significant decision like taking on new loans, selling off a division, tearing up a lease, they need court approval. They can't just act on their own anymore.
Let's zoom in on that first moment. The company files the paperwork. It's day one. What is actually happening inside that building? I assume it's just chaos.
It's controlled panic. But legally, they have to rush to court to get permission to do the absolute basics. This brings us to what are called first-day motions.
Okay.
You have to understand, the moment you file for bankruptcy, you are legally forbidden from paying pre-petition debts.
Meaning any bill that arrived before that filing date?
Exactly. You physically cannot write the check. Now imagine, you're the CEO, you filed on a Tuesday, your employees did work on Monday. Legally, you cannot pay them for Monday's work.
That seems like a recipe for a walkout.
It destroys the company immediately. So the lawyers rush into court on day one with these motions, essentially begging the judge, Your Honor, please let us pay these specific people so we can keep the lights on.
So they are triaging, basically.
Precisely. And while they're scrambling to do that, they get the benefit of the automatic stay. This is the single most powerful weapon a bankrupt company has.
How does that work?
The moment the filing hits the docket, a federal injunction just slams down. All lawsuits, all collection calls, all foreclosure attempts, they stop dead.
It's like a force field.
It is. It freezes the creditors in their tracks to give the company breathing room. But while the company gets a shield, the shareholders usually take a spear to the chest immediately.
Let's talk about the stock. The news breaks. What happens to the price?
It falls off a cliff. We're talking a stock that was maybe $50 a year ago, then $2 on rumors, and then it goes to pennies after the filing. And here's where the scarlet letter comes in. The major exchanges, the NYSE or the NASDAQ, they have standards. They don't want bankrupt companies on their main boards.
So they get kicked out of the club.
Almost immediately. They get delisted.
Yeah.
And the ticker symbol changes. They add a Q to the end. So XYZ becomes XYZQ.
The Q stands for Questionable.
Technically stands for nothing, is just a designator, but questionable is a great way to remember it. It's a warning label. And because of that cue, liquidity just dries up. Most big institutional investors, pension funds, mutual funds, they have charters that strictly forbid them from holding bankrupt stock.
So they have to sell, no matter the price.
They have to sell. So you get this massive wave of forced selling, and the spread between buying and selling gets wide. It becomes the Wild West. But, and this is the hook for so many people, it is still trading. You can still buy it.
And that availability is the trap. People see a stock trading at 10 cents and think, well, the company is still operating. If they fix the debt, this goes back to $50, right?
That is the logic. And to understand why that logic is so fatally flawed, we have to look at who the company is actually working for now. We need to talk about the board of directors. When a company is healthy, who does the board work for?
Shareholders. Their job is to maximize the stock price.
Right. Fiduciary duty runs to the corporation for the benefit of the shareholders, creditors, the banks, and bondholders. They have contracts. That's their protection.
Okay, but as the ship starts sinking and they enter what lawyers call the zone of insolvency, does that allegiance shift?
This is a really nuanced area of Delaware law. For a long time, directors were terrified that once they got close to the edge, they had to serve the creditors or get sued personally. But there was a landmark case, North American Catholic Educational Programming v. Giwala.
Giwala. Sounds like a creature from a fantasy novel, but I know it's a big deal in corporate law.
A huge deal. In Giwala, the court clarified that even in the zone of insolvency, directors do not suddenly owe a direct fiduciary duty to creditors. They still have to exercise their business judgment for the corporation.
Right, because if directors were constantly afraid of being sued by creditors, they would just liquidate every company at the first sign of trouble.
Exactly. They'd fold too early. So Giwala gives them cover to try and save the ship. Another case, Quadrant v. Verton, even reinforced this. It said directors can continue to take risks, even if the company's underwater, if they're doing it in good faith.
But that creates a weird dynamic, doesn't it? If I'm a shareholder of a failing company, I want the directors to take massive risks. A Hail Mary pass.
It's called gambling for resurrection. And while directors can do it, once they actually file for Chapter 11, the reality shifts. The residual claimants change.
Write that down. Residual claimants.
It simply means who gets the leftovers. When you're solvent, shareholders get what's left after bills are paid. When you're insolvent, there are no leftovers for shareholders. The bucket is empty. The creditors are now the ones holding the bag. So, practically speaking, the directors now have to listen to them.
Which brings us to the structure of the payout, the waterfall.
The waterfall.
Yeah.
This is the single most critical concept for any investor to understand. The Bankruptcy Code lays out a strict hierarchy. Picture water flowing down a series of steps.
Oh, yeah.
You cannot get wet on step 2 until step 1 is completely overflowing.
So, step 1, the top of the waterfall. Who's standing there?
Secured creditors. These are the banks that lent money backed by specific collateral like a mortgage on a factory or a lien on the inventory. They get paid first.
Okay, who's on step 2?
This often upsets people, but it's the lawyers and consultants running the bankruptcy. Those are administrative claims.
So the people arguing over the carcass make sure they eat before anyone else.
It sounds cynical, but it's purely practical. If you didn't pay the lawyers, nobody would do the work. Then you have priority unsecured creditors, which includes things like unpaid employee wages, some taxes.
Then we get to the big bucket, general unsecured creditors.
Right. This is the messy middle. Trade vendors, landlords, and bondholders without collateral. They're usually fighting for scraps.
And standing at the very, very bottom, holding a cup with a giant hole in it.
For the equity holders, the shareholders. Common stock is last in line. And this leads us to the absolute priority rule.
It sounds like a law of physics.
It effectively is. The rule states that a junior class cannot receive a single dime unless the senior class above them is paid in full.
In full, meaning 100 cents on the dollar.
Correct. So let's do the math. If the general unsecured creditors, the suppliers and bondholders, are getting paid, say, 10 cents on the dollar, the absolute priority rule dictates that the shareholders, who are junior to them, must get zero.
Zero. No exception.
Almost none. This is enforced through a mechanism called a cram down.
That sounds aggressive.
It was legally aggressive.
Yeah.
In a bankruptcy, creditors vote on the reorganization plan. But let's say a class of creditors votes against the plan. The court can cram down the plan on them, forcing them to accept it. But to do that, the plan must be proven fair and equitable.
And fair is defined by the absolute priority rule.
Exactly. A plan cannot be fair if the shareholders are keeping their stock while the bondholders are taking a haircut. So if the creditors aren't made whole, the equity has to be wiped out.
So for shareholders to survive, literally everyone else has to be paid off 100% first.
That is the general rule. Now, you will hear about rare exceptions. Sometimes shareholders put in new value, fresh cash, to buy their way back in. Or the creditors gift a tiny percentage to shareholders just to speed things up. But these are very rare.
So when we hear about a company emerging from Chapter 11 and people think, great, my stock is saved, that's not what's happening, is it?
No, that is the fundamental misunderstanding. When a company emerges, it's usually a new legal entity for accounting purposes. This brings us to fresh start reporting.
I love the name. It sounds like a laundry detergent. But I'm guessing for the shareholder, it's more like identity theft.
In a way, under accounting rules, companies have to reset their books if two conditions are met. One, the new value of the company is less than its debts. And two, the old shareholders own less than 50% of the new company.
Which, based on what you just said, is almost always the case.
Right. So they trigger fresh start reporting, they wipe out old deficits, they revalue the assets. Basically, the old company ceases to exist on the balance sheet and a new company is born.
And my stock, my old stock.
The old stock is canceled. It's deemed worthless. The new company issues new stock. But here's the kicker. Who gets that new stock?
I'm guessing it's not the folks holding the Q shares.
Right. It usually goes to the creditors. The banks and bondholders swap their debt for equity. They become the new owners. The old shareholders are left holding a digital piece of paper that represents a company that no longer exists.
So my stock in Big Box Retailer doesn't just automatically convert to stock in Big Box Retailer 2.0.
Typically, no. It's extinguished, wiped out.
This is brutal math. The creditors own the building, the inventory, the cash flow. The shareholders own the memory of the company.
That's a good way to put it. And yet,
we look at forums like Reddit and we see people buying these Q stocks. We see retail investors pouring money into companies that have explicitly said in their own filings, your shares will likely be worthless. Why?
It's the lotto ticket mentality. You see discussions where people say, well, the stock is 5 cents. If I put in $100 and by some miracle it goes to $1, I've made 20 times my money.
It's the asymmetry of the bet. Small loss, potential massive gain.
Exactly. And there is a precedent that confuses people. Hertz.
Ah, the Hertz anomaly. This is the story that launched 1,000 bad trades.
Hertz was the exception that proves the rule. During the pandemic, they filed for bankruptcy. It looked bleak. But then a very specific economic miracle happened. The global supply chain for cars broke. The used car market went berserk.
Suddenly, their fleet of thousands of used rental cars was a gold mine.
Exactly. Their assets, the cars, appreciated so much that they actually had enough value to pay off all the creditors and still have value left over for shareholders.
But that was a 1 in a million event. A unicorn.
Completely. But in the retail investor's mind, it planted a seed. Maybe this failing retailer is the next Hertz. It creates a false hope.
There's also this phenomenon of the dead cat bounce.
Right. And for those unfamiliar, it comes from the grim Wall Street, saying that even a dead cat will bounce if you drop it from high enough. You see the stock crash and then suddenly spike 20 or 30% in a day.
And the retail investor sees that green candle and thinks, it's recovering, the comeback is on.
But usually it's just technical market mechanics. It's short sellers who bet the stock would go down, covering their positions. They're buying the stock back to lock in their profits.
So that little spike is just temporary buying pressure.
Exactly. And once they're done covering, the buying stops and the stock rolls over again. The retail investor buys in right as the pros are cashing out. They become the bag holders.
I saw a comment on a forum recently where someone said they were fighting the hedge funds by buying a bankrupt airline stock, like it was a moral crusade.
It's a powerful narrative. The GameStop era convinced a lot of people that stock prices are determined by willpower. If enough of us buy, the price must go up. But in bankruptcy court, math always wins. The judge doesn't care about social media sentiment. The judge cares about the absolute priority rule.
A very sobering reality check. It's not a battle of wills. It's a liquidation of claims.
And remember, trading on the OTC market, the pink sheets, is risky even without the bankruptcy part. Information is scarce. There's less regulation. You're swimming in shark-infested waters.
So to recap, for anyone eyeing a 10-cent stock today, Chapter 11 is a lifeboat for the business, not for the shareholder.
Correct. The business is an entity distinct from its owners. The process is designed to strip the debt off the hull so the ship can float again. But that usually means stripping away the old ownership.
And the absolute priority rule ensures that the people who lent the money get paid back before the people who gambled on the stock get a penny.
Almost always.
And finally, that Q on the ticker isn't a discount sticker, it's a warning sign.
It's a warning that the game is likely over, even if the scoreboard is still lit up.
We leave you today with this thought. We often talk about owning a company when we buy shares. We feel a sense of possession. But in a modern corporation, funded by massive amounts of debt, when those assets collapse and the debt exceeds the value, what do you actually own?
Do you own the company? Or are you just holding a nostalgic piece of paper while the bank takes the keys?
A question to ponder next time you see a stock trading for pennies. Thanks for listening to Talk Tickers.